Hello and welcome to Beekeeper Pramam Hiraldadia. One stock that's in focus today is Allcargo Logistics. Joining us on the show to discuss Q3 earnings as well as the way forward plan with regards to all the updates that are happening. Joining us on the show is Ravi Jakhar, Chief Strategy Officer at Allcargo Logistics. Welcome to the show, Ravi, and a pleasure to speak to you.
Likewise, pleasure speaking with you today.
Thanks. Ravi, my first question coming to you is overall from a Q3 perspective, we've seen a downtick in terms of the profitability as well as the revenue from operations have dropped as well. What is it that has not worked and what is it that has worked during the quarter according to you?
Yeah, so I think, first of all, this was a quarter wherein we received the, demerger order from NCLT, which has been uploaded on their website. And as a result of that, we had to revise the format in which we report our earnings. And therefore, you see continued operations, discontinued operations, and hence the numbers do not perhaps align well. So first of all, I would iterate that the best way to look at the performance is to look at the combined performance, because demerger is anyways a mirror shareholding demerger. So any shareholder owning one share of Allcargo gets one share of all the three listed companies. So if you look at the combined business performance, the EBITDA would be well over 350 crores, which includes the continuing operations as well as the demerged businesses as they would get consolidated going forward in the new entities. So I think there's a little bit of confusion which led to the analysis of higher percentage points being down. Secondly, coming to the business performance itself, naturally the ocean freights have normalized in the past quarter, and that has led to a significant downturn in revenue. But as we've been mentioning over the past, ocean freight for us is largely a pass-through cost, and therefore, while you would notice a decline in revenue of about 970 odd crores, you would also see a corresponding decline in operating expenses of about 900 crores. So this is almost like a pass-through impact which is there. And from a business perspective, all these strategic initiatives are well online. Our global market share continues to expand. For the first time ever, we have now crossed 15% market share in the global LCL business, which is all driven by digitization and service improvements. So on a fundamental basis, this quarter could be seen, one, like I said, the exceptional reporting requirements because of the demerger. There has been a little bit of format change. And from a business standpoint, yes, of course, this has not been the best quarter because the macroeconomic environment driven by China lockdown and other factors, but that's been a temporary one-quarter blip. From a long-term perspective, we're already seeing China is rebounding now. After the Chinese New Year, the country has opened up. Factories are back in operation. Supply chains have started moving in. So from here on, we estimate that the normal trade flows would resume. And on the back of that, our growth in market share would continue to drive our business performance going forward.
Right. So overall, if you have to look at the different segments of business from the international supply chain, or if you talk about CFS or the equipment hiring and logistic parks, where are we expected to see growth? Because overall, if you see in terms of international supply chain, that's where we've seen a decline.
So international supply chain is a robust business for us. And while, like I said, revenues will decline because of freight rates, but ultimately what matters is the gross profit and the bottom line. And those numbers would see a steady improvement since Feb onwards from a monthly basis. And that would naturally reflect in quarters from April onwards, because we are continuing to gain market share, volumes are returning to the market, and profitability impact is already factored in. So therefore, from here on, you would see improved sustained performance. And we are well on line to move towards our guided numbers for 2026, which we have already shared for all the businesses. And so from a fundamental perspective, the businesses are very well placed, market share, digitization, our people, which is the biggest asset in the business. And the most important thing on the back of all these is also where we stand as a company in terms of balance sheet. And that's something where, we have all these strong cash flows. For us, are real cash flows. They don't go back into business. Businesses are extremely asset-light. And what that has led to is the entire debt has been cleaned up. So if you look at the consolidated net debt for 31st December was just about 130 crores. And post-closing 31st December, we have signed the Blackstone agreement, whereby 285 crores debt has moved out of our books. Additional 120 crores cash has moved in, which means that we're effectively now on a net debt basis sitting on cash positive surplus, which will help us, remain cash positive on a net console basis, even after taking care of the acquisitions which you already announced, such as the 30% stake in the operating at the KW, etc. So very well positioned from a balance sheet strength perspective, very well positioned from a market share perspective, and poised for growth. Just waiting for the macroeconomic environment to improve from here on.
Right. So overall, from a strategy perspective as well, clearly, it is becoming asset light, right? And because of which we're demerging two verticals right now. So where are we in that process?
So like I said, we've already received the order on the website of the NCLT. We are expecting the certified copy to come in anytime in the following weeks, post which we file it with the ROC, and then we, follow up the process with the exchanges. Our estimate is that in the month of April, you would see the companies getting listed. So by the time we come out with the annual results, those would most certainly be for 3 different companies.
Right. And by how much are we expecting our capital employed and borrowings to come down by?
So from a employed standpoint, we've already reduced it significantly. Like I said, when the logistics parks got sold to Blackstone, that brought down the capital employed. And now the asset-heavy businesses are being demerged into Trans India Realty, which would focus on logistics parks and asset-owning businesses. So therefore, the capital employed would come down significantly. And from a shareholder perspective, if you look at the return on capital employed, the international supply chain business already has more than 50% return on capital employed consistently, including this quarter gone by. So that robust return on capital employed profile would continue for the main operating business. Gati would also start contributing as it sees turnaround, which has been so gradually, if you notice, it has been growing on the top line. Infrastructure initiatives have been well in place, and therefore the operating margins are in a positive direction. So over the coming few quarters, you would see Gati also starting to contribute. And for the continuing business, which is international supply chain, contract, and express put together, the return on capital employed should continue to improve quarter on quarter.
Right. And with regards to the Blackstone transaction as well, that has been concluded. So what's the update on that, and how do you think it's going to add benefits in terms of company as a whole?
Yeah, so I think there was a transaction done with an intent to deleverage the balance sheet and to reduce the asset ownership. And unfortunately, there were a few small things beyond our control which took significant time for approval. So almost every quarter we were discussing about when this is going to happen. So I'm glad that as we speak today, we're talking about the past. It's already done. The transaction is being consummated. The impact has already come in, which, like I said, it doesn't show in the 31st December balance sheet since the deal has been consummated post that. But there's already an additional impact of 400 crores net, debt coming down and cash coming on books.
Right. So overall, by 400 crores is what we're saying that the debt will come down to. And does this mean we become net positive from here on?
Absolutely. So if you look at the 31st December, yes, if you look at the 31st December, net consolidated debt was about 130 crores against that 400 crores. So it's a minus 270. So we are well positioned. It's a cash positive. We are in a cash surplus situation as far as net debt is concerned.
Right.
Which positions us very well for growth.
Right. Overall, if you see from an FY23 perspective, what's the growth we are envisaging? And apart from that, going ahead, which are the segments of business which will be the growth drivers as well?
So I would say that the international supply chain business for us would continue to be a robust growth driver. In addition to that, we see a strong growth in contract logistics, which has been the case for almost last 4 years. We believe that momentum to continue as people are looking at more and more contract logistics solutions. Express business operating under Gati would also benefit from both the market share expansion as well as the underlying change from the LTL to express market, which has been happening as well. On the terminals business, which is CFS ICD business, we anticipate the growth to be in line with India's EXIM trade, and the business would benefit once the dedicated freight corridor becomes operational, because that is when we'll have another ICD coming up on that. So overall, the businesses that we have retained now are all businesses which are going to be growth drivers. We have already sold out businesses such as project transport, in Allcargo, cold chain in Gati, all the businesses which we are not seeing as growth drivers, we have already sold them off, and we are now very focused on the businesses that we have retained, which are all high growth opportunities for us.
Right. Apart from that, in the budget as well, a clear announcement with regards to the capital investment outlay that has increased by 33%. Now, from a logistics sector perspective, 2022 has been a year of recovery and growth as well, right? Because there have been tangible signs of revival and resilience that have been demonstrated in the development of demand and supply. From here on, taking into consideration the increase in outlay, how do you think it will benefit a company like ours?
So I think, the biggest beneficiary would be trade, and therefore the indirect beneficiary would be logistics. Because when we build out robust infrastructure, better roads, better rates, better industrial parks, it leads to higher production. It also leads to more efficient logistics. And as people move from inefficient, unorganized logistics to more efficient, organized logistics, the share of players such as us increases. So from that perspective, I would say there'll be a double impact. One, increased manufacturing means increased trade and increased exports and imports, which will lead to growth. And improved infrastructure also means higher share of organized. So therefore, there should be a multiplier impact as far as the Indian exports, imports, and the domestic trade is concerned. So we see this to be very beneficial for us across express, contract logistics, and the other businesses of international supply chain and terminals as well over the next 2 to 5 years.
Right. And overall, from a business perspective from here on as well, right? Now, we've spoken about deleveraging, we've spoken about the demerger as well. The plan is going to be to list the entities separately, right? So what are the timelines we're looking at?
So this would be an automatic delisting as it's a demerger of a listed entity. And like I said, sometime towards the end of April, we should see these three companies getting listed separately. And each shareholder of Allcargo, for each share of Allcargo, would get one additional share in the two separately listed entities. And we estimate the process to be completed by around April end.
Right. And overall, Ravi, in terms of milestones for the company from a medium to long-term perspective, what would that be? Because we've taken a lot of strategy shifts currently, strategies which are for the benefit of the investors and the company and the business. So from here on now, what is the next milestone that we're aiming for?
So I think, our strategy has always been proactive and, opportunity led, but always taking a long-term view. So we focused on India's international supply chain as the country's economy got liberalized, went on to build a global business, perhaps the only Indian multinational in the truest sense, with our own offices across 56 countries. Having built that business sometime around 2015, we started building out the domestic supply chain as the Indian domestic consumption grew, and the GST reforms led to significant changes in how logistics in the country operates. And on that back of that, we have been investing and made acquisitions in express and contract logistics, right? So that's been the story. And for the last 3-4 years, we recognize that we have to take lead in digitizing this industry. And we've done exactly that. On the international supply chain business, it's already digitized to an extent wherein more than 60 to 63% of our bookings are already coming through a digital platform. On the operational side, most parts are already automated. We have a digital platform which offers end-to-end capabilities. So a business owner can today get a quote for moving cargo from point to point in like 7 seconds. Usually the expected norms are like 48 hours. So all that has already been done in the international supply chain business. Now we would like to accelerate the digital journey on the domestic supply chain, which is express and contract logistics as well. And the vision clearly is to be the market leader that we are and to be the tech disruptor as well. So that from a long-term perspective, we enable efficient logistics, we enable transparency, we enable digitization, and that will help trade grow, and then help our customers improve their cost of logistics, and also means higher growth for our business.
Right. So overall, if you talk about from FY18 to FY22, we've seen probably a 3.3 times kind of growth in terms of revenue. That's 35% CAGR, whereas a 42% CAGR growth in terms of the EBITDA as well on a consolidated basis. Are we expected to maintain similar momentum or probably outperform what we've already done?
Yeah, so I would say that, from here on, this was about a phase of consolidation, building up the businesses, digitizing, and, all those things have led to a significant transformational growth. From here on, we would look at gaining market share, which means that we would be beating the industry growth rates. And as we use digitization and efficiencies, we'll also be improving our operating margin profile. So we already shared the guidance for 2026, and that holds good as we speak.
Right. And overall, what's the view that you pick up right now in terms of global freight rates right now, specifically talking from a World Container Index perspective as well? How is the dollar per TEU panning out right now, and where do you see it moving, and what's the impact?
Yeah, so I think, from a global container freight index perspective, if you look at it, it had shot up significantly and has now already come down continuously over the 9 to 10 months. And it is today at almost at the levels it was 3 years ago. So the freight rates have already almost got normalized if you factor in just the marginal inflation on costs, etc. And we believe that these rates are likely to remain at these levels, which are more normalized levels. We don't see a bounce back to the earlier higher freight rates. Having said that, if you look at the freight rates for us, which means what is our revenue per TEU, that only expanded a little bit because there was not that much of an impact because these are spot freight rates. And within that also, it's usually a pass-through. So, like for an example, if you look at this quarterly result, you would find that the revenue went down by 970 odd crores. Operating expense also went down by 900 odd crores. It was almost like a pass-through cost. From a freight rate environment perspective, we believe this environment to continue. We do not see a strong bounce back, and that is good for trade. Cargo can move in more efficiently at low cost. More trade can happen, and we are very happy if more trade happens because that means more business for us.
Right. And overall, from a strategy perspective, we have led a strategy which is pretty much proactive in terms of acquisitions, right? So from here on, what's the strategy going to be in terms of acquisitions, number one? And number two, in what segments are we going to look at?
Yeah. So I think, on the acquisitions, we see them as a tool for growth, and we do them very carefully, and which is why we've done almost 18 acquisitions so far. And we have a 100% success track record, which I think is quite unique across industries. And that happens because we know specifically why we are doing an acquisition. We're looking at a new geography, a new product, a new, purpose to any acquisition. So we would continue to look at acquisitions as a tool for driving growth and consolidating our market leadership position. But we do not foresee any large acquisitions. These will be mostly small bolt-on acquisitions, specific target countries where we can focus better. There would be opportunities for us to look at, strategic bolt-ons in specific markets. So those we'll continue to look at those opportunities, which come in a highly value accretive manner. And like I mentioned earlier, we have a robust balance sheet, completely deleveraged now to facilitate acquisitions and to also facilitate other investment plans that we have. So from that perspective, we are well placed, and we would continue to see all growth opportunities, primarily led by digitization, which would really drive the growth.
Right. And my last question coming to you, Ravi, is in terms of overall industry right now, right? From a global market perspective, where is the trade actually moving to, number one, in terms of geographies? And number two, from what's happened in terms of Turkey as well, are we seeing any impact?
Yeah, so I think, there are the biggest impact for the last 3-4 months was because of China easing the COVID policy, which led to significant cases, and therefore factories were closed down, supply chains were affected. We are now noticing that people are back to factories post Chinese New Year. The trade flows have resumed. Other events, there are always a small blip here or there, driven by the global events, whether it is a catastrophe, which was unfortunate what happened in Turkey. Fortunately, less populated area. Otherwise, the magnitude of the impact would have been far worse. So these are, some of the isolated events which, from a business standpoint, would have an isolated, limited impact. But what is more important is that the global economy to recover, the normal trade flows to resume, and we continue to expand our market share and drive growth.
Right. All right, Ravi, thank you so much for sharing your views and the outlook and the way forward for the company and the industry as a whole. Thank you. Stay safe and speak to you soon again.
Thank you. Likewise. Pleasure.